Wealth After 50 presents The 3 Mistakes Keeping You from Getting Rich. I read an article recently with an opening story that was too insightful not to share. It was about an investor who was convinced he mastered stock market trading right up until the moment reality struck. After receiving his first significant paycheck, he invested every dollar into a triple-leveraged tech fund a friend had pitched as a guaranteed success. He then confidently informed his parents he would be retired by 30. 30 days later, the fund had plummeted by 62%. It's a perfect illustration of that gut-wrenching feeling when the market delivers a brutal lesson. The article then diagnosed 3 fundamental money mistakes that prevent people from building wealth, and I want to share them with you. The author emphasized that these are common errors. The objective was to provide a straightforward playbook that helps you retain more of your earnings and allows your capital to work for you. The first mistake highlighted is that most beginners view risk as a binary concept. It's either all or nothing. They either speculate aggressively on assets like meme coins, or they shield their cash in a low-interest savings account, hoping inflation will subside. Both strategies lead to the same outcome: a lack of meaningful growth. The solution is to align your investments with your time horizon. For capital needed in less than 3 years, high-yield savings or short-term bonds are logical. For money you won't touch for a decade or more, low-cost index funds have an exceptional track record, historically outperforming the vast majority of professional stock pickers. A valuable question was posed: if your portfolio fell 30% tomorrow, would you feel anxious, or would you be truly distressed? You must be honest with your risk tolerance and select a strategy that allows you to remain invested for the long term. The second mistake is a temptation many of us have faced. A headline appears announcing, "This fund grew 47% last year, and our fear of missing out overrides our better judgment." The hard truth is that market leadership rotates. The article cited data showing that top-performing funds frequently fall to the bottom half of performance tables the following year. The more prudent approach is to dollar-cost average into broad, low-fee index funds and rebalance annually. This method ensures you automatically acquire more shares when prices are low and fewer when they are high, the precise opposite of an emotional investor's behavior. The analogy it provided is simple but effective. If a quality asset is on sale, you acquire more. When its price is inflated, you hold back. It's the same market, but a far more intelligent way to navigate it. The final mistake is developing an addiction to trading. Every transaction can create the illusion of productivity or managing your money. In reality, the more you trade, the more you lose to fees and taxes. Research consistently shows that frequent traders tend to lag the market by a significant margin. One study found that the most active traders underperform market averages by approximately 6.5% annually. The antidote is simple: establish your investment plan, automate your contributions, and then let the plan work. The author mentioned hiding their brokerage app deep within their phone's folders to curb the impulse to check it constantly. If you still feel the impulse to trade, the article suggested opening a separate fun money account with a small percentage of your portfolio for riskier ventures, while leaving your core portfolio on autopilot. Ultimately, the article's central thesis was that building wealth is not about discovering the next speculative boom or timing the market perfectly. It is about systematically avoiding the major mistakes that erode your capital. To summarize, assume the appropriate level of risk for your timeline, cease chasing yesterday's top performers, and avoid trading as if you're at a casino. By mastering these 3 principles, you position yourself far ahead of the average investor. This is a framework for disciplined, long-term wealth creation. And remember, it's never too late to grow your wealth after 50.